Have you ever felt like you're just constantly one step behind the market? Well, today we're going to pull back the curtain on a really powerful tool for understanding the market's emotional temperature, the AAII Sentiment Survey. We'll break down exactly how it works and how it can give you a pretty unique guide through all the ups and downs. First things first, let's talk about a problem every single investor faces: trying to make smart, rational decisions when the market feels like this, giant sea of emotion, pulling everyone in all sorts of directions. I mean, come on, does this sound familiar? You see a stock go into the moon, you finally jump on board, and then it peaks. Or the flip side, you panic during a dip, you sell, and then you have to just watch as the market immediately starts to recover. It is an incredibly frustrating feeling, and it's way more common than you think. So what is behind that awful feeling of buying high and selling low? A lot of the time, it's just plain old herd mentality. We're wired to be social, and that instinct doesn't just switch off when we're making financial decisions. When the crowd gets greedy, we feel that fear of missing out. When the crowd gets scared, we feel the pressure to sell. And acting with the herd can be an investor's absolute worst enemy. But what if you could actually measure the mood of that crowd? What if you could turn all that emotional noise into a signal you can actually use? Well, that is precisely where the AAII Sentiment Survey comes into the picture. So what is this thing, really? The AAII Sentiment Survey is basically a weekly poll. It's run by the American Association of Individual Investors, and its whole purpose is to take the pulse of Main Street. The everyday individual investors, the people we call retail investors. And listen, this isn't some newfangled thing. The AAII has been running this survey week in and week out since 1987. So for decades now, it's been this super reliable snapshot of what the average investor is thinking, which gives us a ton of historical data to look at. And here's the kind of surprising part. For all the complex data it spits out, the entire survey really just boils down to one single simple question that they ask their members every week. The question is basically this: where do you see the stock market headed in the next 6 months? That's it. And members get 3 choices. They can be bullish, meaning they think prices will rise. They can be bearish, thinking they'll fall. Or they can be neutral, believing things will pretty much stay the same. Simple, right? But incredibly powerful. So, okay, how do people actually use this information? This is where it gets really fun. The most common way isn't to just follow the crowd. Nope, it's to do the exact opposite. It's using the survey as what we call a contrarian signal. The whole idea behind being a contrarian is pretty straightforward. When the investing crowd leans way too far in one direction, the market might just be getting ready to do a U-turn. Extreme, one-sided feelings can often be a warning sign that a turning point is just around the corner. Here's how that plays out. When the survey shows a really high percentage of bearish investors, that's a sign of extreme fear. A contrarian looks at that and sees a potential buying opportunity. On the other hand, when bullishness is through the roof, signaling extreme greed, that can be a big red flag that a market correction might be coming. This quote just nails the logic perfectly. I mean, think about it. If almost everybody who was gonna sell out of fear has already sold, well, who's left to push prices down any further? At that moment of maximum pessimism, the market might have nowhere else to go but up. Okay, so that's the theory. But what does this actually look like with real numbers? Let's walk through how you'd actually decode the results from a weekly survey. So let's just imagine a hypothetical result for a second. Let's say bullish sentiment spikes up to 60%, which is really high, while the bearish camp is down at just 15%. A contrarian investor sees this and thinks, whoa, the crowd is feeling way too good right now. That level of overconfidence might just be a hint that the market is overheated and is probably due for a pullback. Now hold on. Before you run off and start making trades based only on this survey, it is absolutely essential that we talk about its limits. Because this is a fantastic tool, for sure, but it is not a crystal ball. There are a few key things you've got to remember. First, this survey only tracks individual investors. It doesn't tell us what the big institutions, the ones moving the real money are doing. That's why you should never use it in a vacuum. It's at its best when you combine it with other types of analysis, whether you're looking at company fundamentals or technical charts. At the end of the day, just remember, it's a mood ring, not a market guarantee. So, all of this brings us to one final big question. The market crowd has a powerful mood. It can be emotional, it can be irrational. The real decision is how you're going to use that information. Are you going to let the crowd be your guide, or are you going to use its mood as your signal? Thanks for checking out this explainer.